Welcome to White Coat Investor Podcast number 125, How to Rebalance. Welcome back. We're glad to have you here on the White Coat Investor Podcast. We're trying to provide a lot of value for you, try to give you the content you're looking for. If you have feedback for us, stuff you'd like to see on the podcast, stuff you hate about the podcast, go ahead and send me an email, editor@whitecoatinvestor.com. I want to hear about it. Our quote of the day today comes from Warren Buffett, who said, "After all, you only find out who is swimming naked when the tide goes out." That's sure the truth. Make sure that you know about the other opportunities available through the White Coat Investor. For example, we have online courses. You can find those if you go to the main website and you go to the top under the tab called Courses. You will see a link for all our courses. That lists both the White Coat Investor online course, Fire Your Financial Advisor, which helps you to write your own financial plan that you can follow to financial success, as well as some of our other online courses that we've either put together, sometimes from our conferences or from some of our partners or affiliates. But if we think there's a great course for physicians and other high-income professionals that you can take online, we put it on that page. Also, be sure to sign up for our email list. You can sign up for all the cool emails we send out at whitecoatinvestor.com/email. And there's a lot of great things. There's a monthly newsletter, which includes a blog post that isn't even published on the blog. There's a weekly summary digest that gives you a very quick blurb and a link to each post published in the last week. There is also a link where you can sign up to get every podcast notes and blog posts that we publish sent directly to your email box. We also have a new list we're putting together for people interested in real estate opportunities. So if you're interested in private real estate opportunities with syndicators, funds, etc., and you want to learn more about those and when webinars talking about them are going on, be sure to sign up for that one. All of these you can unsubscribe from with one click. There's no commitment. It's totally free. But if you're not getting those, you're missing out on a lot of the stuff we are creating each month. Our sponsor today is Earnest, one of the student loan refinancing companies. Save money on your student loans by refinancing with Earnest. Choose custom terms to fit your budget, like pricing your exact monthly payment or selecting fixed and variable rates. Earnest Precision Pricing matches your custom term with a custom interest rate, saving you even more money when refinancing. You won't be passed off to a third-party servicer nor penalized for making payments early. Your family is always protected with loan forgiveness in cases of death and dismemberment. The minimum amount to refinance is $5,000 and the maximum is $500,000. So the chances of you being outside those two limits is pretty low. That's pretty broad as these companies go. But there's more. If you sign up to refinance your loans and actually complete a refinance, after going through this link, whitecoatinvestor.com/refi, that's REFI, you will get $500 cash back. Seriously, $500. Use it for whatever you want. You can go buy Wendy's and buy a little what do they call them? Blizzards? Is that what they are? Frosties at Wendy's. Once a day for the next year and a half if you want. But I would encourage you to take that $500, put it toward your loans, and pay them down a little bit faster. So refinance your loans today with Earnest, whitecoatinvestor.com/refi, REFI. Thanks for what you do. Medicine is not easy. A lot of you aren't doctors. We've got other healthcare professionals. We have attorneys, we have business owners, we have engineers, we have tech workers, all kinds of people listen to this podcast. And what you're doing is likely difficult. That's why it pays so well. But it's also important. And, you're contributing to society, you're helping people, and I want to thank you for what you do because chances are nobody said thanks at work today. We have a special guest today, one of our featured financial advisor partners, Marty Watkins from TrueNorth Wealth, that we'll be getting on the phone here and talking to for a few minutes and answering some questions together. Okay, we have a guest today, one of our featured financial advisors. This is Marty Watkins from TrueNorth Wealth, where they say integrity and our commitment to our clients come first. We stay true to our clients' direction in wealth, not ours. And we pride ourselves in being a fee-only firm and a fiduciary on every relationship. We advise on our client's entire financial picture, true comprehensive planning. By coordinating investment, retirement, estate, tax, insurance, and small business planning, we ensure every financial aspect of your life works in synchrony to your best interest. Regular reviews of financial plans allow us to foresee potential problems, give advice based on the current economic climate, and plan for any major life changes. Now, there are actually two offices to TrueNorth Wealth. The first one is in Utah. It's in Salt Lake City and Logan, actually. There's two in Utah. But there's also an office in Boise, Idaho that does business as the Idaho Medical Association Financial Services. So for all you Idahoans, that's the firm we're talking about today. But these guys will work with clients across the country. Like all of our recommended financial advisors, they are used to working with people by phone and email and video conference. So you can reach them at TrueNorthWealth.com. or 801-316-8175. I actually first became aware of Marty through one of my neighbors. He was one of his clients, a doc on the verge of retirement, and he'd hit me up at church each week to see if the advice he was getting was good. And it always was, although it was interesting that he always came with these questions that were controversial, those things that never have a right answer in financial planning and investment. And so we'd talk about those, but I think he was very reassured when he realized he was getting good advice. So thank you for taking care of my neighbors, Marty, and welcome to the podcast.
Well, thank you. I'm delighted to be here, and am delighted to help your neighbor as well.
Yeah. So let's start with a little bit about you and why did you become a financial advisor?
Well, I started off college in mechanical engineering, and in my first drafting class, I frankly hated it and got a B. And thought, I can't do this the rest of my life. And I happened to be enrolled in a personal financial planning course at BYU with a Dr. Pierce. And I loved it. It came natural to me. It was very enjoyable. And I thought, this is really the direction I want to head. So from really that first semester at BYU on, I knew what I wanted to do.
Now, what is it that makes your firms, I should say, so unique, both TrueNorth Wealth as well as Idaho Medical Association Financial Services? What's unique about your firm?
Well, we have an extensive physician and surgeon background in that when I finished at BYU, I immediately started a firm with the Utah Medical Association called UMA Financial Services. I wanted to be a fee-only planner. I couldn't quite accomplish it there because they felt like they needed some insurance products. But trying to be a fee-only planner at 24 years old, when primarily who you deal with is people your parents' age or older, was difficult. And so I approached them about the idea of them providing somebody that would give their doctors financial counsel and help them avoid the big mistakes that they can so often make. I approached them. They loved the idea. I created UMA Financial Services in the fall of 93. That grew to be very large and very successful, and we ended up not agreeing on compensation. So I went out on my own and created TrueNorth Wealth and IMA Financial Services. So I work with the Medical Association up in Idaho, and primarily in my career served physicians and surgeons, probably now over 1,600 of them. We're a unique firm in that we really have four major areas that we help in. We do institutional consulting. We advise on over $14 billion in institutional dollars, including one of our largest client actually is my 529, the Utah 529 plan, that I've been a consultant from an investment content standpoint since 1998. We also have a 401k division. We help some family offices and, of course, private clients like our physicians and surgeons. And generally, the business owner iteration of those and more complex circumstances are the type of clients that we've attracted over the years.
Now, your ad on the White Coat Investor says you do academically sound financial planning. What do you mean by that term?
Well, we, much like medicine, you're striving to always go out and find the data that supports why you would do a certain thing. And there's a lot of research that's been done, much of it during my lifetime, that supports some methods over another. So we strive to follow what makes sense. Usually that means a pretty boring portfolio that's quite cost effective.
Yeah, now a lot of times when people talk about academics, they also get into factor investing. Does factor investing play a large part in the portfolios of your clients?
They do. Primarily for our individual clients, we use DFA or dimensional for the equity component part of our portfolio. And we also, of course, use Vanguard, and they happen to be the single largest component part of our portfolios across the institutional to retail space. So we do use factor investing and think the work that Dimensional and Ken French and Eugene Fama have done is spectacular work.
Now tell us about your fee structure at TrueNorth and why you decided to do it that way.
So we actually have a fairly flexible fee schedule. We've just recently, actually, we're working on right now amending our ADV to a $1,000 planning fee to help our early professionals have an opportunity to get things set up right from the beginning and try to be as cost effective in delivering that counsel as we possibly can so that they can avoid the early mistakes that, boy, if they make them, they just compound over time. And if they can get it right at first, whether it's dealing with student loans, et cetera, we really want to make sure that they make the right choices right from the beginning. So we have a platform that we can charge a $1,000 fee to early professionals trying to make sure that they get their affairs in order. And then we have an assets under management fee. We start at 78 basis points for the first 250,000, then to 0.72 or 72 basis points on the next 1.75 million, then 0.58 on the next 2 million, then 0.48 on the next million, and then it goes to 0.43 to 10 million, and then 33 basis points, 10 million and above. And really, we end up being flexible on our fee schedule, largely because the complexity of a client can vary dramatically, and the amount of time that we spend with them, if they have multiple business entities and we're coordinating with attorneys and accountants regularly, just is a ton more work. And so we try to just make sure that we're adding value in every circumstance and are cost effective in every circumstance, and that clients are getting good outcomes and being charged fairly.
All right, let's move on to some questions from our listeners. This first one came into me via email. There's actually two questions here. He says, I am a full-time anesthesiologist in Northern Virginia. For the past 2 years, I have significant student loan debt, $377,000, that I refinanced to a rate of 4.375%. I'm a W-2 employee with Kaiser, and I'm maxing out my 401k and backdoor Roth IRA, and I was just wondering if I should pay off my loans before I put some extra money in an index fund. I already have an emergency fund in place and pay off my credit card debt each month. Do you think I should wait to buy a place until after I pay off my student loans? So 2 questions there. Should I pay off my loans or invest in index funds in a taxable account? And should he wait to buy before paying off his student loans? What would you say to him, Marty?
Most people end up using a bifurcated approach where they will work hard on paying down their debt quickly, make sure they're getting all the matching, and if they have an HSA, of course, funding that first, and do some after-tax investing, particularly if they're paying charitable contributions so that they can have some tax benefits there. And they'll be paying off their debt early on a scheduled methodology at the same time. I will say that I have had a number of clients that really focus in on paying down their debts as quickly as possible and will only put money in a pre-tax account or an after-tax account above the emergency fund just to get the match or the HSA contribution. And everything else they throw at debt. And usually because of that display of discipline, those are clients that really build wealth quickly and are very successful. But most of our clients have done kind of a two-pronged approach where they try to pay down the debts early and also maximize their pre-tax contributions in the backdoor Roth, et cetera.
You know, it's interesting you mentioned that. That's kind of the approach I take. I mean, there's obviously a spectrum here, all of which is reasonable. You know, some people feel like they get their student loans to 2 or 3 or 4%. And, well, geez, am I not going to beat that, investing? If I'm not, then I might need a new investing approach, at least over the long term. And so I don't think it's unreasonable to carry a little bit of debt for a while. But what I've found is docs really don't want to have student loans 5 years into their career. That they really feel tied down by them. And if they can get rid of them in the first 5 years, that they feel like they can make different career choices, different family choices, that they just don't have this huge weight hanging over their head anymore. So I've kind of told them to live like a resident, and that way they can do both. They can both max out all their retirement accounts, and they can pay off their debt within 5 years. Now, the really aggressive ones might pay it off in 2. The less aggressive ones might pay it off in 5. But I think people dragging it out for 15 years often regret it and often become kind of unfocused and undisciplined. And so I think that's probably similar to the experience you've had with your clients.
That's exactly right. The discipline displayed to pick, say, 5 years, put it on an amortization schedule and get through it and be done with it and move on is a great indicator of future success financially.
It's like a dry run for financial independence. If you can pay off your student loans in 5 years, you can become financially independent in 15 or 20.
Right. And those that go out and buy an $800,000 home right when they're done and are struggling with student loan debt and making that payment, their building of wealth is hampered significantly.
Yeah. How about the second question from this anesthesiologist about waiting to buy until the student loans are gone? Do you think that's overly conservative? Do you think that's a good idea? What do you think about that approach?
Well, if he's in a stable situation, I'm all for owning and buying and paying off the home that he would live in. If he's not resolved to be in that community for an extended period of time, or hasn't made partner, if it's that type of group, or comfortable with the employment situation, then maybe he should wait. But I wouldn't just put off buying a home because he still has student loan debt. It would be the other factors.
Yeah, I mean, if you're one of these people that are just piling the money on student loans and you expect to pay them off in 13 months, well, maybe it's not crazy. But
right.
For the most part, I agree with you. You know, if you're in a stable personal and professional situation, it's time to buy. I mean, in the long run, buying usually works out a lot better. And so the sooner you get on that, the better. But you also don't want to be, you know, one of the 50% of docs or whatever that change jobs in their first 2 years and now have a big mortgage payment hanging around your neck, keeping you from being able to do that.
Well, and I've been doing this for 31 years now. You know, you get to watch scenarios where people purchased a home in an area that, let's say, even somebody that buys a home during residency, and that marketplace happens to go down during their training, and they have to write a big check before they can sell that house. But if your situation's stable and you're earning a good income, just fast forward as much as you possibly can, getting rid of the debt, and buying a reasonable house is fine.
Okay, so our next question comes in off the speak pipe from Mike.
Hi, Dr. Dolly. My question is about portfolio rebalancing. Rather than sell from the oversized asset and transfer the proceeds to the undersized one, I've always just invested additional funds out of pocket and purchased more of the smaller one. Am I making a mistake by not locking in those returns? By proceeding in this manner, I've always used it as an incentive to invest even more, and I'm still theoretically buying low. Thanks so much for any insight you can give. Bye.
So to summarize, Mike's kind of asking, should I rebalance with new investments or do I have to sell assets that have done well to do it properly? And I thought this was such an important question. I actually named the podcast after this, How to Rebalance, because I think there's a lot of people that get a little confused about this. What would you say to Mike about that?
I think it is a great question, and it's easy to do if you would globally look at your portfolio, so qualified plans, Roths, et cetera, and your after-tax account. You can essentially not create tax ramifications and rebalance if you're looking at more than just an after-tax account. But if that account's sequestered for a specific purpose that, say, predates 59 and a half, unless you're going to do some other techniques that would make retirement plan dollars available at that point, if it needs to have a specific allocation, then I wouldn't let the tax ramifications drive it. I certainly would identify tax lots and make sure you do it efficiently. But there's also an opportunity if you're donating to charity to keep raising your basis in these securities as you go forward by donating the shares with and you talk about this that you purchased at the lowest price or the highest margin. When you put the money that you would have paid in cash to the charity, if you pay that then to your account and use that to rebalance with the dividends and other new cash going into your after-tax account, usually you can do this in a very, very tax-efficient way, even in an after-tax account, particularly those that give to charity.
Yeah, I think that's exactly right. And I think most people will find in the first half of their career at least that it is very rare that they have to sell an appreciated asset in a taxable account in order to rebalance. I've now been investing for 15 years. 15 years I've been investing. I have never sold a taxable asset at a gain. Period. I haven't done it. And I haven't had to do it to rebalance. I haven't had to do it for any other reason. And so I think what most people will find is that they can just, most of the time, rebalance with just the new contributions, especially in their first decade of saving. And secondly, even after that, most of the time, especially if you've been, reading the White Coat Investor blog or listening to this podcast, you've probably been maxing out some pretty significant retirement accounts, and you can do a lot of your rebalancing inside those accounts.
Right, and avoid it altogether.
Yeah, and I think at the other end of life, if you're 85 years old and thinking about, selling taxable assets, you got to start going, well, shoot, how much longer am I going to be around before my heirs get a step up in basis? And so I think there's really only a few decades there in the middle where people are finding they have to deal with this issue, that they actually have to, to keep their portfolio balanced, they have to sell something that's appreciated in a taxable account.
Right. That's been my experience as well. And we try to algorithm our portfolios as much as possible. It's part of what helps us keep our fees low. And it's very rare that there isn't enough cash flowing into the account that it would trigger a rebalance on an after-tax portfolio. So even on a systematically rebalancing portfolio, if it has cash flow going into it, and if we're doing charitable contributions and do it wisely, to experience a taxable capital gain is extremely rare.
Well, speaking of charitable contributions, let's take our next question off the speak pipe. This one comes from an anonymous listener and a tithe payer, as are probably many of your clients in Utah and Idaho. But let's listen to this one.
Hey, Dr. Dolly, I've heard you talk a lot about tax loss harvesting and also donating appreciated gains. I'm at a position where I am maxing out my retirement accounts now, but I give about $20,000 a year to charity religiously as a tithe. And as of right now, my taxable accounts only generate about $1,000 to $2,000 in gains a year, which I do try to donate. I was wondering what you thought about using leveraged ETFs or a broad diverse of more volatile stocks to maximize tax loss harvesting and to maximize the appreciated gain donations. For instance, if you were in more volatile stocks, some of them will go up a lot. Those ones you could donate since we're donating anyway. And then the ones that go down, you could sell for a tax loss harvesting. Or is this just completely too risky and too complicated of a strategy? Obviously, when I get to the point that my taxable accounts are large enough to cover all of the donations, I won't even be in this issue. Would love your thoughts on this. Thanks.
So to summarize, it sounds like he's asking, what do you think about leveraged ETFs or funds or particularly volatile asset classes in order to maximize the tax loss harvesting benefits and the donation of appreciated shares to charity benefits? Do you think that's worth having a different asset allocation than you might otherwise have?
I do think it's an interesting question and an important one to be raised. I wouldn't go that direction at all. I prefer a long, boring game plan that is cost effective. And if you're just patient and have a good portfolio, you'll have plenty of opportunity to give away gains and donate to charity that way. What you might find is in that type of a leverage technique is that you have a whole bunch of losses that you at least get some tax benefit by writing off some income, but it's a long road to go down if it goes against you. And so I'm not a big fan of letting the tax tail wag the dog. You should invest in something because it's a good long-term investment. And generally speaking, boring is better, and those certainly are not boring. So in short, in the long run, it's wiser to buy kind of a boring, inexpensive, I think, factor-based portfolio and donate the appreciated shares within that rather than an exotic, expensive, and volatile portfolio that might have some dramatic gains that you could give away and magnify your donation in certain years. To me, it doesn't fit within the overall idea of being a wise investor.
I think that's exactly the right answer. However, I also have a confession to make that I considered this question a few years ago and chose what, in retrospect, was probably the wrong answer. I didn't choose leveraged ETFs. I think those are pretty lousy investments. But I did put some stuff in my taxable account, primarily knowing that I was going to donate any gains. And if I had any losses, I would tax loss harvest them. I had more asset classes than I probably would have put in there otherwise. I think I put my small value in there a little bit. And, I had some emerging markets, which I don't actually break out in my portfolio these days. And I had, I think, Vanguard's precious metals mining fund and, a couple of others like that. They weren't terrible investments overall. It wouldn't have killed me to hold them for a few years. And I knew I'd eventually be able to flush out any gains anyway. And, what I found is exactly what Marty said, that after a few years, you have so many losses anyway that you have booked just using regular, boring old total stock market, total international stock market kind of funds, that you've got plenty to get your $3,000 in tax losses a year and make up for any possible capital gains distributions you have. So why mess with your asset allocation? If you thought this asset allocation was good, why are you adding other stuff to it just for, as you say, to let the tax tail wag the investment dog? I don't think those benefits are large enough. And I think after a few years, your portfolio will be big enough that you get all those benefits without having to use any sort of, exotic leveraged ETFs or anything like that doing it. So I confess I tried it. It didn't hurt me particularly badly by any means because, I donate a lot to charity each year. And so I was able to flush out the gains, no problem, and rearrange my portfolio without difficulty. But I can't pretend it was a good idea, and I certainly can't advocate it. So I think Marty gave exactly the right answer on that. All right. Well, thanks so much for coming on to the White Coat Investor Podcast. For those who would like to ask Marty more questions, you can find him at TrueNorthWealth.com. Also can be found as the Idaho Medical Association Financial Services, and you can call at 801-316-8175. Thank you for coming on the White Coat Investor Podcast.
Thank you so much. I appreciate it very much. I would like to express my gratitude to the physicians and surgeons that spend so much time and effort being trained properly and late nights that they spend to care for those that are injured and sick. I happen to be a person that my wife teases me that I've burned through my 9 lives if I were a cat and more. And it's doctors that have saved my life on multiple occasions. And I'm very grateful for your commitment to excellence and dedication to helping those even when you might not feel the best or it's the end of a long day and the next person comes in and really needs your care. I've been that guy, and I'm very thankful to those that have served me, and I just want to express my gratitude to you for all that you do in the profession.
Thank you very much, Marty, and thanks again for being on the podcast. That was great to have Marty on the podcast. After we stopped recording, we actually had a discussion about a recent change in umbrella policies. Apparently, a lot of the major issuers of umbrella personal liability policies have made a change in the last few years such that they no longer cover excess liability for uninsured and underinsured motorists, which if you look into umbrella policies, about 80% of the claims on umbrella policies are auto-related. And so when you actually use the policy, which doesn't happen very often, that's why they're so cheap, it usually comes related to your auto use. And so that's a pretty significant change to have something that they're no longer covering there. Now, that's never been my favorite type of auto coverage to start with, but there could be a need there for that. You need to look into it and understand how it works. And, you may need to reshop your umbrella policy if you want that additional coverage. All right, let's take another question off the speak pipe. This one's anonymous from a Pacific Northwest hospitalist.
I have a tax deduction question. I'm an independent contractor and I live in Seattle. I travel 7 days a month to Southern Oregon and travel 7 days a month to Central Washington for hospitalist shifts. And I travel to these sites on a recurring basis. I'm wondering if I can deduct the travel expenses with a standard mileage deduction for the trips between Seattle and these locations. I also wonder if I were to fly to these locations, if I could deduct the airline price. Thank you.
Okay, so can you deduct your travel expenses when you're working away from your home? Well, work-related travel expenses are deductible. As long as you incurred the costs for a taxi, plane, train, or car while working away from home on an assignment that lasts 1 year or less. So those are all deductible. You can also deduct the cost of laundry, meals, baggage, telephone expenses, and tips while you're on business in a temporary setting. So you have a choice about how to deduct the cost of your meals that are business related or eaten while you're on an unreimbursed travel excursion. You can either deduct 50% of the actual meal cost, or you can take 50% of the per diem rate for the location of your travel. And you can find a list of those cities on the IRS website and figure out exactly what is the better option there. But yeah, your work-related travel expenses are deductible. You got to keep in mind that the real thing people get in trouble with is they try to deduct their commute. Your commute is not deductible, but if you're going to another city and staying overnight and working shifts, those are work-related travel expenses. All right, our next one comes from an anonymous person on the speak pipe.
Hey, Dr. Dolly, thanks for all that you do. I'm a longtime reader and listener, and I've benefited greatly from your work. I'm a 30-year-old ER doctor working in a community hospital in a rural part of the western United States. I'm engaged to my partner. We are set to be married next year. We currently have no children. Our financial plan is to max out pre-tax retirement account using an individual 401k through Fidelity and to fully fund backdoor Roth IRA and HSA. I have approximately $200,000 in student loans with an interest rate less than 3% and may be eligible for significant loan forgiveness next year given the rural location of my practice. I make around approximately $360,000 a year as a 1099 independent contractor. The only other debt we possess is approximately $30,000 in car loans. My partner is a teacher but currently only working part-time, making a small annual salary. She suffered the unexpected loss of her father a few years ago and inherited money as a result. She has more or less ignored this money since his passing as she feels obvious complicated emotions surrounding it. We were hoping to address it prior to our marriage next year. Let me preface this by stating that we are in a very stable relationship, having been together for more than 11 years, and I know she shouldn't give me any access to any of this money prior to being officially married, which she hasn't. That being said, she has the following accounts. She has a My Mutual Fund account with New York Life worth approximately $180,000, an inherited IRA worth approximately $50,000, and a separate taxable account through Morgan Stanley worth approximately $160,000. What would you recommend we do with these accounts? She is currently in the lowest income tax bracket. Will making any changes before we get married have large tax implications? Can we use some of the funds from the taxable accounts to fund pre-tax retirement accounts in the future? Thanks for your time and all the work that you do.
Basically asking, what should my fiance do with $350,000 in taxable assets she's been ignoring before we get married and our tax bracket goes up dramatically? Well, I was pretty impressed with that call. That was an impressive amount of information conveyed in 90 seconds. Usually you don't have enough information to really give good answers, but that was really a pretty impressive summary. Chances are a lot of those taxable holdings are less than ideal holdings and should be swapped out for what you really want, some decent index funds, now that she's in the 0% long-term capital gains bracket. While you're in a low bracket, take advantage. This is a great time to realize gains. This is a great time to, change your portfolio around. Even if it costs you a little bit of money, it's probably still a great time. And so in this case, you usually don't want to mess with the other person's finances until, you're truly married. I recommend against people paying off someone else's student loans until they're truly married, for instance. But in this case, boy, it sure makes a lot of financial sense to make some changes before the marriage occurs and the tax bracket goes up dramatically. All right, the next one comes from Chris on the SpeakPipe.
Hey, Jim. I'm wondering if you have tips about how to start transitioning from all tax-protected accounts to opening a taxable account. I've been maximizing contributions to a 401k, a 457b, HSA, and backdoor Roth for my wife and I since finishing residency, and everything else has gone towards my loans, which I just paid off. Now that extra money is going to a Vanguard money market account towards a down payment on a house. But after we buy the house, I'll start putting those savings into a taxable account. But I'm struggling to figure out the best approach for this. So my 5 aforementioned tax-protected accounts have about $100,000 between them, and each of them has a basic 3-fund portfolio of total stock market index, international stock index, and total bond index, each one at my desired asset allocation. I know, however, that my new taxable account should preferentially contain tax-efficient funds like the total stock market index, and the tax-free accounts should preferentially have tax-inefficient funds like the bonds. Well, anyway, this throws off my system of just having the same asset allocation in all of my accounts. And so I'm envisioning putting all my extra savings into a total stock index fund in the taxable account, and then adjusting my allocations to my other 5 accounts to be more bond heavy. But how do you do this and maintain your asset allocation across the board? Any tips or resources would be helpful.
So he's basically asking, how do you start a taxable account? Well, unlike a 401k or a Roth IRA, where if you kind of botch it a little bit in your investment selection, there are actually consequences to changing your investments in a taxable account, as we learned on that last call. If you have capital gains, it's going to cost you some money to change investments. And so most people inside a taxable account try to stick with pretty tax efficient kind of investments. So if you're investing in bonds in your taxable account, you want to be using muni bonds if you're in one of the higher tax brackets. If you're investing in stocks, we're usually looking for something like a total market index fund, the total US market, total international market. Those are kind of the holdings you have there. If you're investing in real estate, rather than put your hard money loans there, your debt kind of investments, you should instead put your equity real estate investments in there, because you can shelter some of that income by depreciation. And some of it, of course, is going to come in the form of capital gains. And so that's better than the ordinary income you'd be getting from most debt deals. And so you want to set it up right the first time if you can. And then, of course, as time goes on, one of your accounts generally gets bigger than the others. Whether it's your taxable account, whether it's your tax-protected account, you will find that you are moving portions of your asset allocation from one account to another. You're essentially buying more of, small value stocks or, total international stocks in one account than you had in the other one. And so in general, what you want to do is avoid realizing capital gains as you do that and stack them into the taxable account if necessary in order of tax efficiency. You don't want to necessarily take your real estate investment trust and put them into the taxable account first because that tends to be a very tax inefficient asset class. You generally try to avoid putting TIPS, Treasury Inflation Protected Securities, into a taxable account as well for the phantom tax issue, where basically they're sending you a tax bill for appreciation that you're not actually getting on that investment. And so that's generally held in a tax-protected account as well to avoid that complexity. All right, our next question comes off the SpeakPipe question. This one not from a doc, but from a doctor's wife.
Hi, Dr. Dolly. First, I would like to thank you for all you do. It is so reassuring to know that you are out there helping doctors and their families navigate through the world of personal finance. I'm a doctor's wife. My husband is currently in a 1-year fellowship and has asked me to help him with the search for his first attending job. After reading your blog and listening to the podcast, I know how important that first job really is. However, I can't help but worry that we're so unprepared for this whole process. Between recruiters, compensation reports, and few of our physician friends willing to talk about money, how do I ensure my husband gets fair pay for his work? What is your opinion on compensation reports like the MGMA? Further, we've never had to negotiate a contract before, worry about restrictive covenants, or ensure we had proper benefits. I was wondering if you had any advice on how to get a sound first attending job that sets us up for financial success. Thank you.
Okay, she's asking, how do I make sure my husband's paid fairly? What's your opinion of MGMA? How should we negotiate a contract? All good questions. It's wonderful to have somebody else in your corner helping take care of this stuff while you're busy learning how to practice medicine. But these are obviously pretty important questions as you come out of residency. So how do you make sure you're paid fairly? Well, the only way to do so is to know what you're worth. And the way you know what you're worth is by finding out what other docs that do similar work to you are getting paid. Now, you can do that in some ways by calling up all your residency mates that graduated last year, find out what they're doing at their jobs, where they're at, and what they're getting paid. And that'll give you a pretty good sense for what your value is. If you want more specifics, particularly for local geographic areas, it can make sense to look at more fine-tuned data. Now, Medscape every year will publish some information about salary surveys. A lot of specialties have their own salary survey. For example, in emergency medicine, Daniel Stearns does a fairly complex survey of salaries each year. But I don't know that something like that is available in every single specialty. So that leaves people to go to MGMA. And this is a company that compiles data, salary data for doctors and similar professionals. It uses this to make a profit, right? They sell the data. They sell this data to hospitals and other people who are hiring docs. They sell it to docs who want to know what they're worth. But it's going to cost you, several $100s, sometimes $700 or $800 to get access to that data. It's not super cheap. One of the best ways to get a hold of it, however, is to hire a contract negotiation firm or contract review firm. Most of these, including the ones I put on my website, like Contract Diagnostics, will provide this data to you as part of their service. So they're going to review your contract for you, go over it, help you understand the terms and which ones might not be that good. They can help you negotiate it if you need to. And they will also tell you if you are being paid fairly. And so I think that's totally worth spending a few $100s on your last year of residency or fellowship as you're getting ready to move on to your adult job, and to not only understand what could happen with this contract if you're not happy with them or they're not happy with you, but also just to know you're not getting hosed, that you're getting a fair price. You'd think it wouldn't be that hard, but it is. You don't get paid what you're worth. You get paid what you negotiate. So you can check out our recommended firms at whitecoatinvestor.com/contract-negotiation-and-review. It's under the recommended tab on the main website. All right, our next question comes from an anonymous employee doc with a simple IRA.
Hi, Dr. Dolly. I'm a employee physician in a 2-physician practice. The only retirement package available to me through my employer is a simple IRA. I've been maxing this out for the last 2 years. My understanding is, in the reading when I signed up for it, I have to leave the money in this particular financial institution for 2 years from the start date, the day the account was opened. I believe I'm not able to roll this over into another financial institution or another retirement product until I hit that 2-year mark, which will be December of this year. My question is it worth it to me to go ahead and do all the necessary paperwork and roll it over into another institution as soon as I'm eligible to do so that I can take advantage of the backdoor Roth IRA? I know that I have to get all of my money out of other IRA accounts because of the pro rata rule. Because I plan on continuing to stay with this employer and use this simple IRA again next year, is that even something that is an option to me? Can I actually, once eligible in December, roll it over into a 401k at another institution, take advantage of the backdoor Roth IRA, and then contribute again next year to this simple IRA plan? Or is that going to just open up a whole can of worms? Thanks. I appreciate your help.
And he is basically asking, is it worth it to do a rollover as soon as I am eligible to do a backdoor Roth IRA? Well, here's the deal. If you have some old simple IRA, it's pretty easy to get rid of it. If you are making ongoing contributions to a simple IRA every year, that's not super compatible with a backdoor Roth IRA. You basically have to choose between the two. You can either do a backdoor Roth IRA and not use your employer plan, or especially if you're getting a match from the employer of any kind, use the employer simple IRA plan and just not do a backdoor Roth IRA. It's not the end of the world to not do a backdoor Roth IRA. You can invest in a taxable account and be just fine. I would also spend some effort trying to talk the employer out of that stupid retirement plan, though. I do not like simple IRAs. They are not great plans for docs. The contribution limits are not very high, and they keep you from doing a backdoor Roth IRA. They have this funky rule that you got to leave the money in there at least 2 years as well, which you don't see with most retirement accounts. And so, I'd try to talk your employer out of doing that. But in this scenario, if you're going to be making ongoing contributions every year, you can't roll it all out of there. You're always going to have something in there. So it's really not a great option. Okay, this question comes from the White Coat Investor Forum, where they ask, should I overfund my 529 plans on purpose for tax reasons as personal investment and estate planning tool? So this question is getting at a separate use of an educational savings type of account called a 529, besides for college. He's talking about saving for retirement in the 529. And a lot of people think about this. They're like, well, all that tax protection over the years must be worth more than the penalty when I take the money out. And the truth of the matter is that it is not without a dramatic decrease in your tax brackets between your working years and when you retire. And most people considering doing this probably won't have as large of a drop as the average person there. And the reason why is twofold. One, when you pull that money out and don't use it for education, you got to pay a 10% penalty. And two, when you pull that money out and don't use it for education, you've got to pay taxes at your ordinary income tax rate, not the lower capital gains rates. And so in that respect, it's like an annuity, but a bad annuity because there's an additional 10% penalty. And so, yes, you get protected while it grows, but when you pull it out, you end up paying such higher tax levels that this is not going to come out ahead. You're going to end up better off investing just in a taxable account. And you also get the other benefits of a taxable account, right? You get the ability to tax loss harvest any losses. You can donate appreciated shares to charity. You get the step up in basis at death. You can gift the shares to family members and they can sell them at their lower tax bracket. There's lots of different things that can be done in a taxable account that can't necessarily be done in a 529. So use your 529s for education. Don't use them for retirement, and just stick with standard retirement accounts plus a taxable account there. The only one that I think you can really use for a purpose it's not designed for effectively is a health savings account. But even there, the best use of it is to spend it on healthcare eventually. Okay, another one also coming from the White Coat Investor Forum. If you've never joined this forum, it's great. It's found on the main website. There's some very knowledgeable people there. I think there's 6,000 or 7,000 members, and you'd be surprised how quickly and how high a quality of answers you get to rather complex questions. And you're getting them from docs and you're getting them from financial professionals. Unlike the Facebook group, we let financial pros on the White Coat Investor Forum. And so that's a real benefit there. So check that out if you get a chance. But here's the last question we're going to do here. I'm an orthopedic fellow currently until July 2020. Our situation is a current stay-at-home wife, not a physician. We stand to make about $90,000 gross in 2019, accounting for my fellow salary and stipend for my next job that I've already signed with. 2019 will be our lowest earning year, hopefully, for probably the next 20 to 30 years. We both had 403B accounts at our previous job, residency, and this amounts to about $30,000 combined. We recently sold our home where I did residency, and we were fortunate to sell it and make a decent profit after 9 years. That's a long residency. They must have had it before residency. We do have about $60,000 saved from the home sale to 1, max out 2020 Roths at the beginning of the year, and 2, a decent chunk for a down payment on our next house following fellowship. My current plan is to roll over these 403Bs into our Roth account since we are no longer employed and intend to pay the tax burden out of that $60,000. Would you have any cautions in this regard? No, I think that's a great plan. The idea is you don't want to pay the taxes for a Roth conversion out of the account that you're converting. And so when you have some money on the side to pay for that, like most people do as they come out of residency, come out of fellowship, that's usually a pretty good use for your money. Now, this is even better because he's doing it the year before he comes out of fellowship. He's doing it in 2019, comes out of fellowship in 2020. So this is really a great opportunity to do some Roth conversions. Now, bear in mind, if you're still at the employer, they usually won't let you, roll that money out to a Roth IRA and convert it until you actually separate from the employer. So for most people, you're trying to do this year you leave residency. But if you can do it earlier in residency, or heck, do it as a medical student, that can really be a great tax move. So our sponsor for this episode was Earnest. Earnest is really great because you can choose custom terms to fit your budget. So you can pick your exact monthly payment, or you can select your interest rate, or you can select the term, which is what most people do, is they decide how long they want to pay, and then Earnest tells you what the interest rate for that term is going to be. You can get fixed and variable rates, and they don't pass you off to third-party servicers. They don't penalize you for making payments early. They protect your family in the event of your death or disability, and the minimum amount to refinance is super low, $5,000. And the max amount is pretty high, $500,000. So if you have debt between $5,000 and $500,000, you can refinance with Earnest. If you go through the link I'm about to give you, you can get $500 cash back as well. And please put that toward your loans and pay them off even faster. That link is whitecoatinvestor.com/refi, REFI. Refinance today with Earnest. Also, be sure to sign up for our email list. You can find that at whitecoatinvestor.com/email. And thanks to those of you who are giving us a 5-star review on the podcast and telling your friends about it. It really does help us spread our message of financial literacy for docs and other high-income professionals. Head up, shoulders back. You've got this and we can help. We'll see you next time on the White Coat Investor Podcast.